Hello, everyone, and a very warm welcome to the first episode of the CalCPA's Disaster Recovery Series. By way of introduction, my name is Andrew Pitt, and I am a tax partner at GHJ Advisors, a national accounting, tax, and advisory firm. Today, we're embarking on a critical journey to demystify one of the most immediate and often confusing aspects of recovering from a natural disaster, understanding casualty losses and, surprisingly, even casualty gains. When you're grappling with the aftermath of a devastating event, like the tragic 2025 LA County fires that swept through our communities, the financial impact can feel like an impossible puzzle. But rest assured, the IRS has established specific rules designed to help you navigate these complex waters and provide some measure of relief. Let's begin with a fundamental question. What exactly does the IRS consider a casualty for tax purposes? It's not just any damage to your property. The Internal Revenue Service specifically defines a casualty as the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. This is a crucial distinction. It's not about the slow decay of a leaky roof over years or the gradual wearing down of a driveway. Instead, we're talking about events that strike abruptly and without warning. Think of the intense heat and swift movement of the LA County wildfires consuming thousands of homes in a matter of hours, the overwhelming force of a sudden mudslide following heavy rains, or the jarring, unforeseen tremors of an earthquake that caused structural collapse. These are distinct, unforeseen occurrences that fundamentally alter your property's condition. This definition ensures that only losses stemming from true, unforeseen catastrophes qualify for special tax treatment. Now, let's move into the essential mechanics of calculating your disaster-related financial impact. This process requires a precise understanding of a few key financial terms. The first is your adjusted basis in the property. Conceptually, your adjusted basis represents your investment in the property for tax purposes. It typically starts with your original purchase price. To that, you add the cost of any significant long-term capital improvements you've made over the years, things like adding a new room, replacing a major system like plumbing or electrical, or undertaking extensive landscaping that increases the property's value. From this total, you would subtract any depreciation you may have properly claimed on the property if it was ever used for business or rental purposes. This final figure is your adjusted basis. The second crucial element is determining the decrease in fair market value of your property as a direct result of the disaster. This is calculated by comparing your property's fair market value immediately before the disaster struck with its fair market value immediately after the disaster. To assess this, you might need appraisals or reliable estimates. When calculating your potential casualty loss, the IRS generally limits your starting point to the smaller of these two amounts, either your adjusted basis or the actual decrease in fair market value. Let's walk through an example of calculating a casualty loss specific to the 2025 LA County fires. Imagine your home in Malibu, purchased for $800,000, which you've improved over the years by adding a new deck and solar panels costing $50,000. Your adjusted basis in this home is now $850,000. Tragically, the 2025 LA County fires swept through your area and your home sustained significant damage. Before the fires, your home was appraised at $1.2 million. After the fires, due to structural damage, smoke, and partial destruction, its value plummeted to $400,000. So, the decrease in fair market value is $1,200,000 less $400,000 equals $800,000. In this scenario, the smaller of your adjusted basis, $850,000, and the decrease in the fair market value, $800,000, is $800,000. So your initial casualty loss before insurance would be $800,000. Now let's factor in insurance reimbursements. Any amount of money you receive from your insurance company for your losses directly reduces the amount of your casualty loss for tax purposes. Continuing our example, let's say your insurance company paid you $600,000 for the damage. Your deductible capital loss would then be reduced to $800,000, the initial loss, less $600,000, the insurance payout, equals $200,000.
After you've considered insurance reimbursements, New federal rules under the OBBA change how victims of the 2025 LA County fires calculate their disaster-related deduction. Taxpayers no longer must reduce the loss by 10% of their adjusted gross income, and the floor is now $500. Additionally, for federal income tax purposes, you do not need to itemize to take the loss. California, however, still follows the old rules, which require their 10% AGI reduction, a $100 floor, and still treats the loss as an itemized deduction. We'll delve deeper into these new concepts in a later episode.
Now let's tackle a scenario that often causes confusion and even distress, the concept of a casualty gain. This occurs when your insurance payout for the damaged or destroyed property actually exceeds your adjusted basis in that property. Consider this realistic example for the 2025 LA County fires. Imagine your home in Topanga had an adjusted basis of $500,000. It's tragically destroyed by the wildfire. However, because property values in your area have significantly appreciated and your insurance policy was robust, your insurance company gives you a payout of $800,000. In this situation, you've received $300,000 more than your adjusted basis, resulting in a $300,000 casualty gain. While it might seem counterintuitive to have a gain when you've lost your home, this is a very real tax implication that must be addressed. The good news is, as we'll explore in a later episode, there are often ways to defer this gain by reinvesting the proceeds into a replacement property. Finally, and I cannot overstate this, meticulous documentation is the cornerstone of a successful financial recovery. From the moment the 2025 LA County fire struck, you must commit to gathering and organizing every single piece of relevant information. Start by taking extensive photos and videos of the damage before any cleanup or repair work begins. These visual records are invaluable. Create detailed lists of all damaged or destroyed property, including major structural components of your home, personal belongings, appliances, and even landscaping. For each item, try to include the purchase date, original cost, and estimated fair market value before the disaster. Save every single receipt related to your recovery efforts, temporary repairs, professional cleanup services, debris removal, temporary lodging, and any other expenses incurred directly due to the disaster. When you're working with professional appraisers to assess the full extent of the damage, engaging with your insurance company to file and pursue claims, or hiring contractors to rebuild or repair, make sure you keep comprehensive records of all communications, detailed estimates, signed contracts, and final invoices. This thorough paper trail is not merely good practice, it is absolutely essential to substantiate your claims to the IRS and your insurance company to maximize your tax benefits and to ensure the smoothest possible financial recovery process. The stronger your documentation, the more effectively you can navigate this challenging period. Thank you, and stay tuned for episode 2 for tax relief and rebuilding after a disaster.